Welcome to the podcast from Morningstar UK, the leading provider of investment news, views and analysis. This week, we analyse the impact of this week's UK budget report and how to navigate falling global stock markets. Let's start with the budget. Whilst Phillip Hammond's announcements of tax reductions and spending measures may boost Britain's high street retailers, the positive impact on investors is likely to be limited, says Morningstar's investment management's Dan Kemp.
The last budget before Brexit felt a bit like the end of a long car journey with children. As the destination gets closer, those in the back seats become increasingly fractious, while those in the front pass out sweets to create distraction and bring temporary harmony. At these times, it's difficult to think and act long term, but it's essential as investors that we do so. With that in mind, a few things were noticeable about the budget. First, the sweets were widely distributed, with additional money for the rollout of universal credit, defence, education, health, tax cuts and even potholes. The budget was clearly designed to engender the impression of fairness, generosity and optimism. Second, the sweets all came in small wrappers. While the absolute numbers may appear to be large to us as individuals, they are likely to represent a limited benefit to those involved in implementation or to the economy as a whole. Third, this was clearly a pre-Brexit budget. The numbers that the Chancellor is using to justify the increased spending may look very different if no deal is reached by the end of March, necessitating an abrupt turnaround in spending and borrowing. So what does it mean for investors? The answer is likely to be very little, but with a wide band of uncertainty around that statement. By not making bold spending or tax changes, it is likely the budget will be mildly beneficial for the economy. However, the impact on the long-term value of UK stocks is likely to be muted by the fact that approximately 70% of the profits of the companies in the FTSE 100 index come from countries outside the UK. In this context, UK equities continue to look attractive. In contrast, the impact on gilts may be more significant. Lenders are seldom happy when borrowers spend more, and therefore a move away from austerity may add to pressure on gilt yields, which already look very unattractive. While some budgets elicit a lasting change to the economy or financial markets, this does not appear to be this type of budget. Rather, it appears to be a myopic budget with the objective of quietening down the government's car as we approach Brexit. As investors, such short-term actions are simply the background noise of the long-term endeavour of identifying attractive assets that are going to deliver above-average returns over the long term. The budget appears to have done little to change the opportunity set for UK investors, and so we remain focused on the road ahead.
Now onto global markets. During times of uncertainty, even the most experienced of fund managers get scared of volatile markets. Up next, Aberdeen Standard's Hugh explains his fears about a trade war are justified, but says investors should stay the course or they risk missing the recovery.
Hello, Hugh.
Hi, good morning.
So it's fair to say, I think, that sentiment towards Asian equities this year has not been great. There have been quite significant outflows, but there have also been quite significant headlines. How much of the fear do you think is warranted?
I think a fair bit of the fear is warranted, so concerns primarily over trade wars are absolutely justified, and we are seeing the economy in this part of the world slow as a result. That's bringing down earnings for certain sectors, I mean not everywhere. And of course at the same time, as markets fall, one becomes more and more excited about value on offer as and when it arises. But certainly there is reason behind the falls. We've had currency wobbles, fears over economic growth levels, and the rest. And we've seen some dramatic falls after some dramatic rises in some of the sectors. So the IT sectors, the internet, and so on. We've seen dramatic pullbacks in certain parts of Asia.
And it's easy for you as a professional investor to say that these drops create opportunities because you're seasoned, you've been doing this a while. But for the retail investor, quite often the psychology of those significant falls makes it very difficult to stay the course, let alone put more money in. So what is the messaging that we should be giving to retail investors in a volatile market such as this?
It is hard, and I totally understand why people, of course, see sharp falls and oh my goodness, I don't want to go there. And of course you look back on on it and say, well, if only I had started to nibble. So in many ways, that's why, for me, I'm very comfortable with things such as savings schemes, where you just put money in, and even I get scared in these markets, so I understand that. But then you look back and use your experience, and if you do your homework, either as an investor on funds, for example, to invest in and characteristics of funds, and don't bet the bank on them, and I think that's the way to do it. But it's not easy when people get scared. As the old adage of markets being driven by fear and greed is absolutely correct.
And looking then at those opportunities, are there any particular sectors that you're seeing at the moment which you think are particularly compelling?
Well, we're seeing some value arise across markets. Particularly, we're seeing some quite sharp falls in some of the smaller cap stocks within the region. So as a general sector, if you call that a sector, that's appealing. Some of the IT technology stocks have pulled back sharply as well. Some of the more stable, steady eddies have actually held up quite well in this environment. So your consumer stocks and the like, which didn't perform very well in previous years, have held up well. So for us, it's more a matter of looking at the things that have pulled back sharply and where we're comfortable that the fundamental business is still strong. We're gently topping up.
And what then about countries? Because I know over the years your love affair with China has been on and off. I was researching before this interview. So we spoke in 2011 and you said that you were avoiding China at that time. At the moment, with it hitting the headlines so significantly, trade war rhetoric, slowing economy, what is your feeling on China at the moment?
I mean, to put it in context, we've always been keen on China in a broad sense. It's a massive economy, bits of it are growing very fast, and there's some exciting developments. And our reservations were largely to do with individual companies, whether we had sufficient comfort with them, some of the accounting issues and so on. And over the years, of course, as we see more and more how these companies act, we get more and more comfortable. So we have been steadily putting more money into China on a selective view, but there's still lots of reasons to worry about China. Parts of China will be amongst the worst hit by what looks like quite a nasty trade war as we speak today. So for us, I think it's again a matter of just being careful what stocks we buy within China. So we're using this as an opportunity to add to China.
Hugh, thank you very much.
Thank you.
Our next guest, Michele Hardeman, Head of Global Markets for Asia Pacific for State Street, explains to our Senior International Editor Emma Wall how falling emerging market currencies have impacted investor confidence.
Hi, Michele.
Hi, nice to be here.
Thank you very much for being here. We're here today to talk about investor confidence and how the market has influenced that. I know that State Street have recently done an investor confidence survey, which interestingly, unlike some others in the market, isn't just based on opinion, is it? It's actually based on trades. And what has it found?
Well, we found that the investor confidence index has come off quite significantly. Normally you look at 100 being the baseline, so currently it's at 88.3. So it shows that investors are actually investing in more risk-averse assets, moving away from the high beta assets and taking a much more conservative approach to their investments.
And are there any sort of regional disparities? Because this is a global index, isn't it?
We are seeing regional disparities. Europe has been up a little bit, North America's down and Asia's been down quite a bit, and I think you can see that reflected in the emerging market currencies. If you think about the flows that we've seen in recent weeks, obviously we are seeing a huge move in US Treasuries. We're seeing a wind back of quantitative easing, and that has a significant impact on the emerging market Asian currencies in particular. We would favour an investment profile that sort of looked at current account deficit countries versus current account surplus countries and favour those for investments. But certainly at the moment, the market's very concerned about, the US Treasury market and the equity market and the interest rate differentials, and so the impact that will have on Asia.
And are they right to be worried? Because of course the way that investors act isn't necessarily the correct way, the way that fundamentals perhaps suggest, because we are emotional creatures, humans.
I think they're right to be concerned. I think when you start to have a big shift in central bank policy, that's when you normally get major turns in markets. And so if you think about the fact that the US are winding back their quantitative easing and having a much tighter sort of monetary policy, we anticipate there's going to be 3 further hikes, into the next year, and that starts to weigh heavily on the emerging markets because people are buying back into the US markets or they're holding more cash. What ends up happening is that you end up seeing an export of inflation back into the emerging market countries, which is unexpected, and I think that people are now starting to think that the consequences of higher dollar are really going to start feed through to the emerging market currencies in a fairly significant way.
And why is Europe seemingly swerving this kind of negativity? Because of course Europe is not without problems. We've got Brexit on the horizon. Turkey obviously has been beset by currency issues. Why do you think that investor confidence is slightly higher in Europe?
I think that there are starting to see some general signs of inflation picking up in Europe. Obviously over the weekend you saw that the Brexit negotiations appear to be on a better footing. So I think people expect that there'd be some resolution there. The other thing to always remember about Europe is that a lot of European trade is within Europe, and so that they're less susceptible to the pressures of a strong dollar. The euro is still weak, and the sterling obviously had a fairly strong rally overnight. But I think that going forward, we would expect that the strong dollar will continue to accelerate.
Michele, thank you very much.
Thank you.
China shares have had their worst October in a decade, and the sell-off recently was the largest since January 2016. Is the fear warranted? And how does this impact the value of other emerging market countries? Morningstar Investment Management's Tariq Bourbon is up next to explain.
Markets continue to be quite volatile, and there is plenty for investors to be worried about. Thinking about the trade war between the US and China, where there are actually risks that things could escalate a little bit further. Obviously, markets have reacted to that, to a certain extent pricing in some of those risks, and we feel they are probably the most priced in on the emerging market side. So one of the worst performing markets this year has been China. Chinese equities, both the local markets and the offshore markets, is down between 10, 15, 20% this year, especially from the early February peaks. So what we're finding generally is more value emerging there as valuations have become more attractive. There is some pressure on the fundamentals, which has yet to come through the numbers, as we are seeing more weakness coming through the Chinese economy, which has been well publicized, hence why the markets have been weaker. So in general, finding more value in emerging markets, whilst on the other hand, US equities, which have been a standout performer this year, driven mainly by tech on record profit margins, are definitely a lot more stretched when we look at their valuations. US more expensive, emerging markets cheaper, but within emerging markets, selectiveness is important. So China is, for instance, a lot cheaper at about 13 times earnings. But if you look at India, you're still finding stretched valuations at about 20, 22 times earnings, with high growth expectations for India. So important to be selective within emerging markets. Simple message, yes, there is volatility. There has been for many years in emerging markets, but relative to other parts of the world, EM equities are more attractive in our view at this point in time.
So how do we go about finding value in troubled emerging markets? Our next guest, T. Rowe Price's Ernst Young, says we should look for stocks which are uncorrelated to trade war fears and US central bank policies.
Hi, Ernst.
Hello, Emma.
So we've had an interesting start to October. Some people were saying we were on track for the worst October for markets or Asian markets since 2008. It has rallied a little bit towards the end of last week, and we're mixed today. What has caused such a significant sell-off, and do you think it's warranted? Are the fundamentals really that bad?
Sure. Admittedly, I think 2018 has been more volatile than I initially expected, but let's put it into context. I think we have had 2.5 years of really good performance in emerging markets. So I think giving something back is actually quite normal. However, admittedly, if you look at all the survey that's been done by economists, you will know that emerging market and US dollar rate and S&P index do have a close correlation. The correlation could be as high as 75%. So now that rate is being hiked, it's natural to expect that there will be some pressure on the emerging market. However, I would point out the very interesting point is within the emerging market, people see that as one asset class, but we're actually talking about 30 countries with 3,000 stocks. So some country correctly will be under pressure, like the topical country of Argentina, Turkey. They need US dollar funding and their macro are fragile. So I think their correction is well justified to some extent.
Now, I suppose the next logical question is which are the unjustified pullbacks? Because you have a broad remit and a value focus, so you will be looking for opportunities. Where are you seeing those opportunities?
Sure. So I like to look at countries that other people are not investing in or they're overlooked. So I would give you some example here. If you assume US dollar rate hike will continue, actually countries like the Middle East will benefit a lot because their currency is actually pegged to the US dollar. Oil is at 80 now, so it's actually pretty good for the macro. The current account is becoming stronger, and a lot of the banks will be beneficiary of US dollar rate hike. And there are sectors that has no bearings to US dollar rate hike as well. For example, China old economy has been undergoing significant SOE reform or supply side reform. I think those industries are not really correlated to US dollar or rate hike at all.
And that's quite interesting because old China is an area where a lot of other fund managers who invest in Asia and across emerging markets are actually avoiding because of the old in the name. They say that people are moving away, but you're saying actually there are opportunities within those companies.
Yes, I think it is bringing back to my first point. I think old economy, people hit it with a barge pole and think everything is bad. There are bad apples out there, let's admit it. So we're not going out there and buying a basket of old economy stocks. However, some of them are changing. For example, we know that at the trough of 2015 and 16, some of these companies were at the verge of bankruptcy. And that expectation is still vivid in the management's mindset. So let it be the government pressurizing them or the management themselves are trying to change because they were back in the corner and they know they need to make the right decision. So we are seeing a lot of examples like that in the emerging market space.
And finally, I know that you don't have a crystal ball, but should investors expect this volatility to stick around for a bit longer? Is this going to be a period, like you said, we had 2.5 years of a very strong performance. Are we going to have around 2 years of perhaps more difficult, more volatile times?
So I will answer your question in 2 points. First of all, like I mentioned, we have a very diversified asset base that we can invest in. So I think active stock selection really matters. If you go in, don't just buy the index, try to find opportunity like Middle East that I mentioned that will benefit in the current macro mindset. However, the second point I will mention is equity normally follows fixed income. And our fixed income colleagues is actually turning very bullish. They think the real rate of many emerging markets is becoming very attractive now, and they want to deploy their capital there. So in terms of currency, in terms of fixed income, valuation and tactical are getting very attractive again. So as a stock picker, I think they are signaling to me that capital outflow may be subsiding somewhat, and we can go back to focusing on the fundamentals and pick out pockets that is attractive to our fund holders.
Ernest, thank you very much.
Thank you, Emma.
FTSE and MSCI have announced plans to include more mainland China listed shares in their indices. Morningstar's Director of ETF Research in Asia, Jackie Choi, is up next to explain the impact this has for passive fund investors.
Hi, Jackie.
Hi, Emma.
So before we get into the latest developments in the ETF market, I thought we should quickly touch on what's been going on in equity markets in Asia, because it's been a pretty bad couple of weeks, hasn't it?
Definitely bad couple of weeks. It's not just Asia, it's actually like worldwide. And especially in Asia, you see like the heavyweight stock tanked 20% year to date so far this year.
And September wasn't so bad, so it really has just been October that has seen quite considerable losses, as you say, in the A-share market in China, across Asia, and indeed actually globally.
Indeed, yeah. It's really just starting from like October.
And so now we've got that out the way, I thought we could talk about what has happened, some positive news for ETF investors. There have been some developments to do with indices, haven't there?
That's right. So recall that in August, at the end of August, MSCI has completed the first 2 steps of including A shares into the indices. So towards the end of September, FTSE Russell announced to include A shares into their indices as well. And just one day before MSCI, FTSE actually, MSCI proposed to increase their stake in Asia as well. So a lot of things happening in the Asian market.
And when will investors see this new inclusion? Because it's not immediate, is it?
It's not immediate. So FTSE will include them from June 2019, and MSCI is proposing to increase their inclusion factor from their May 2019 review. So it's not immediate, but then like from sort of like next year onwards, things will be like getting complicated a little bit in the A-share sort of market within the index world.
And how much is this increase? Because I know we talked last month about how significant the MSCI inclusion of China A shares were into its Asia and emerging markets indices. And you were quick to point out that although it was quite a significant move, the actual proportion of the index still remained quite low.
That's right.
So will this still be the case for FTSE and indeed for the increase for MSCI?
Right. So first of all, let's talk about like MSCI. So last time we talked about after the August inclusion, the weight of China A shares within the MSCI EM index was 0.7%. But if the new proposal go through, like increasing inclusion factor, adding mid caps for A shares, that will increase the weight for A shares to 3.5%. So not that big, but still a very big portion from the origin of 0.7%. And for FTSE, the inclusion would, after the 3 tranches of sort of inclusion for FTSE, that will increase A shares from 0, obviously now, to about 5.5%.
And that is quite a significant increase. You're basically saying for ETFs that track those particular indices, you're going to go as an investor from having absolutely no exposure to the China A share market to having 5.5% of your portfolio invested in those stocks.
That's right. So that obviously the index will change, and inflows would go into the Asian market to buy into these Asia as well. So quite a big change. But just one sort of note for investors: some of the FTSE indices already included Asia. For example, the FTSE EM China Inclusion Index, which one of the Vanguard ETF tracks, already includes A shares at around like 4%. So investors really have to understand the actual index which the ETF tracks.
Jackie, thank you very much.
Thank you, Emma.
Most of the money in emerging market bond tracker funds and ETFs is linked to JP Morgan benchmarks. So the bank's plans to include Gulf nations such as Saudi Arabia, Kuwait, Qatar, United Arab Emirates and Bahrain from January 2019 will have an impact on investors tracking those indexes, explains Morningstar's Jose Garcia Zarate.
JP Morgan has announced plans to include Saudi Arabia, Kuwait, Qatar, United Arab Emirates and Bahrain, all of which are members of the Gulf Cooperation Council, in its flagship emerging market debt indices starting from January 2019. These will cover conventional bonds and sukuk, or Islamic bonds. Historically, these countries had not qualified for inclusion in the JP Morgan indices due to their high levels of income per head, as well as, with the exception of Bahrain, their highly rated sovereign debt. However, most investors would agree that these countries share many characteristics with emerging market economies. To make them eligible for inclusion, JP Morgan has introduced the purchasing power parity ratio as a new parameter for selection. Countries with a ratio below 60% will now qualify as emerging markets, even if they don't meet the other criteria. This adds flexibility in the selection process, but by the same token, it also makes it more difficult for countries already in the emerging market index to be upgraded to developed market status. The inclusion of the GCC countries will be done in monthly stages through to September 2019. And by the end of the process, the combined weight of these countries is estimated to be between 10 and 12% of the index. This will significantly boost the representation of the Middle East region in the benchmark, but will also require the index to redistribute the weighting of other regions. Most of the money in emerging market bond passive mutual index funds and ETFs is actually linked to JP Morgan benchmarks. Also, these are the indices of reference for the vast majority of active funds in the space. So we may expect a comprehensive reconstitution of portfolios in 2019. Overall, the inclusion of the GCC countries is a welcome development. Over the past decades, these countries have become very active issuers in international government bond markets as they try to diversify their economies away from heavy reliance on fossil fuels. In fact, 2016 and 2017 were record high years for bond issuance for these countries. This will make the JP Morgan indices more representative of the emerging market universe. It will also increase their overall credit quality and potentially decrease volatility.
What are thematic ETFs and why should you be wary of them? Robotics, ESG, artificial intelligence, thematic ETFs are growing in popularity, but investors should look before they leap, says Morningstar's Kenneth Lamont.
Hi, Kenneth.
Hello, Emma.
So thematic investing, in particular thematic ETFs, what are they?
Well, a thematic ETF is an ETF which invests in stocks based on a specific theme. For example, artificial intelligence or robotics or e-commerce. The ones I've just listed are all tech funds, but they're not limited to tech. They could be social themes such as aging populations or environmental themes such as water or alternative energy.
Is it fair to say that tech have probably gained the most traction? There's a lot around at the moment about artificial intelligence, robotics, and that sort of investment.
Well, tech is the big driver of our age, so it's unsurprising that a lot of these big structural changes which are being tracked are in tech. Specifically, the robotics funds have really caught the imagination in the last couple of years.
But as you say, it's not just limited to tech. It branches across environmental and indeed even gender.
Absolutely. There's a fund which selects stocks on gender characteristics. Generally, funds will use revenue sources and actually committee approaches where they meet and actually decide how pure an individual stock is in their exposure to the underlying theme, for example.
So the key question is, what should investors be wary of before jumping on this bandwagon?
Well, as always, there's buyer beware, particularly when you step away from main market cap vanilla products. But primarily, you should invest in a robust strategy. These products are quite tricky to evaluate. They have little or no, often, performance history. And in fact, the theme by its nature is yet to play out. So. And even after the fact, they're quite difficult to assess in terms of performance because often they have no direct peers or few direct peers with which to evaluate.
It's also worth considering how they fit into a portfolio, isn't it? Because these should only ever be a very niche holding in someone's portfolio.
Absolutely. They're tricky products all round. The narrative makes them very attractive, but when you actually sit down and ask yourself how you want to fit them into your portfolio, you have to understand the individual risk and return drivers associated with that product.
Kenneth, thank you very much.
Thank you, Emma.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.